Can I get a hard money loan to fund the seller financing down payment, then do a seller carry back on the second lien? Yes. So for those of you that aren't familiar, hard money is kind of like a institutional money. They are a little bit more laid back. Generally, hard money lenders are also real estate investors. And hard money just means that it's going to be more expensive than traditional financing. So a good example of hard money is like right now, bank rates are like 7%, 8%, somewhere in there. A hard money lender is probably going to be 10, 12, maybe even 15%. And they're going to charge origination points. So they might charge anywhere between 1% and 4%, or they call them points when they're talking about charges or fees that they're going to assess for originating this loan. So 1 point is 1%. So if it's $100,000, they're going to charge you $1,000 just to make the loan. 4 points or 4%, they're going to charge you $4,000 just to make the loan. And then you have the ability to purchase that property, potentially rehab that property. And during that time, you are going to be paying the 10 to 15% that this hard money lender is charging. And then once this property is fully rehabbed, you're going to, and then occupied, you either, if you're going to rent it, then it should be occupied and you should kind of season that renter being there. Or if you're going to sell it, you can put it on the market, list it for sale, sell it. And then at the closing, you can pay off that hard money lender and keep the remaining profits from that flip. If you plan on keeping it as a rental, then you get that property occupied. You wait a couple of months, whatever your traditional lender wants to see as far as seasoning goes. And then you refinance with a traditional bank and then pay off that hard money lender. Now, all of the hard money lenders that I could think of off the top of my head are going to want that first position mortgage on the property. So I would suspect that if you have access to hard money, they're going to want to be the first position. And if it's a good deal, the hard money lenders are going to be willing to finance that entire deal. I don't think that I would borrow this down payment. I would do it the opposite. So if the hard money lender is going to require that you put 25% down, I would not use hard money for the 25% down to the seller down payment. I would use that hard money lender, give them a first position mortgage, and I would ask the seller to carry the 25% down. This might be what you're asking. I may have read it wrong. And we have done that a couple of times on deals where the person selling the property helped us with that 25% down payment. Now, when we did it, we did not use the property that we were buying as the collateral. We gave the seller a first position mortgage on another property that we had as collateral for that 25% kind of carryback that you're talking about. And I think that would be a little bit more clean, and it wouldn't, if you're buying it anywhere close to retail, you don't want to be 100% leveraged on a property. You don't want to owe 100% of the market value of that property. So it's definitely possible. If you want the seller to be that first position mortgage holder and you want them to carry the bulk of it, then what I would suggest is coming up with some other way of getting that 25% down payment that's not a hard money lender. I would look at maybe doing like a personal loan, maybe doing something creative with a credit card, using like plastic.com or something to where you can get a check sent for the down payment on that seller financed property and see where that goes. But I would not necessarily, borrowing hard money for a down payment wouldn't be my first choice. Again, I think the appropriate formula for buying a property is purchase price plus rehab cost is equal to or lesser than 75% of that after repair value. So in the event that you want to borrow 100% of the purchase price and the rehab cost, just make sure that you're still solving that after repair value and you're still not going to be all in for equal to or greater than 75% of that after repair value. And that's really important because so long as you're at 75% or lesser of the after repair value, you can approach a traditional lender later on down the road and you can get 100% of the money borrowed back out on long-term financing, because most traditional lenders will do 75% loan to value, and then you're safe. And then you have a property on long-term financing that you did not have to put any of your own money in. And that is how you can scale very quickly, because so long as you're never putting any of your own money into a deal, then you're never going to run out of money. It's also really important, though, to make sure that you have enough reserves on the side that is your money to come up with anything that might go wrong and pay for that. But that's exactly how our business model works. We borrow 100% of the purchase price and the rehab costs. However, we are really strict in making sure that we never borrow more than 75% of the after repair value, because we don't want to bring any money to the closing whenever we're refinancing on the long-term debt. We want to be able to take the bank's money and pay off in full that initial private lender or hard money lender. Because again, the more of your own money that you have to inject into a deal, the smaller your bandwidth becomes. There we go. That was a fantastic question. I really appreciate you asking it.
Thanks for watching that clip. I thought that was a good question. And I think you can ask good questions too. Join us every Friday morning at 8 a.m. Eastern Standard Time for a live stream Q&A where we answer plenty of questions just like this one. In the meantime, consider subscribing to the channel if you want more of this content. And if you want to increase your deal flow, analyze properties better, and help me feed my family, click the link below for a free 7-day trial of PropStream.